Hi guys, welcome to our next topic. It's chapter 11 and it talks about what we call behavioural research. And behavioural research is about the way people make decisions, people react to certain things. And sometimes a theory might say, well, a person should do this based on being rational. But behavioural research can also look at the fact that people may be irrational when they're making decisions. Okay, so that's what today's lecture is all about. So what I'll do, I will share my screen and we will get started. So as you can see, we do have some learning objectives. I would suggest you revisit them after you've watched the lecture to make sure that what's in these objectives, you can say, yes, I have learnt that, okay? I have learnt that, because at the moment they probably don't mean a whole lot to you until we go through our information. There's quite a bit to it, okay? Now, there's different ways to assess the impacts that financial reporting decisions have on financial statements users. Okay, so one way we can do it is by saying, did this information impact on share prices? Now, that's what we call capital markets research, okay? Alternatively, we can look at the impact of the information on the decisions of individuals, how individuals make decisions here. And we call that behavioural research, okay? So behavioural research in accounting examines how individuals react to various accounting disclosures. And it's based on what we call decision theory or behavioural decision theory, which has been used in psychology and those sort of things for a number of years. So the goal of this behavioural research is to describe how people make decisions, evaluate whether they do make good decisions, and then understand the underlying psychological processes. Okay, so we're talking about what's happening to the individual, whereas when we look at capital markets and we're looking at the impact on, say, share prices of the disclosure of information, we're looking how the entire market has reacted. So one is quite macro, you could say, and one is quite micro. Now, according to Bernberg and Shields, behavioural research in accounting can be defined as research that applies theories and methodologies from the behavioural sciences, so that would normally be something like psychology, to examine the interface or the interrelationship between accounting information, okay, and how humans process that information, okay. A lot of research makes a lot of simplifying assumptions, say like markets are efficient. Behavioural research does not make these broad-based simplifying assumptions, okay. What behavioural research is trying to do, it's trying to improve decision-making. And as I said earlier, it takes a lot of its insights, or a lot of the information it's developed from psychology, okay? Now, behavioural research in accounting has been used to investigate many things, and amongst these include, how do individual analysts go about valuing a share? How do loan officers at a bank go about deciding whether to give a loan or not? How do auditors or bankers assess whether a firm is bankrupt? Or how do auditors assess the risk of, say, one of their clients? What's the decision-making process? Okay. So according to Trotman, it's about evaluating the quality of judgments of auditors, preparers, and users, how good their judgments are, understanding how judgments are made, determining which factors impact judgments, developing and testing theories of the processes. So how are judgments made? What mental processes do we go through? Improving the judgments of auditors, preparers, and users. Okay. Now, what this does, if we are able to identify any deficiencies, this then means that we can have a situation where we can address those deficiencies, okay? So that's a pretty important outcome, and that can obviously make things better when analysing companies and those sort of things, okay? Now, with that in mind, the next thing that we need to look at, okay, is the experimental setting. Now, this is a really interesting area if you think about it. A major benefit of experiments is that the researcher creates the setting in which the experiment is carried out. So when you're doing behavioural research, you have to replicate the real world. So the researcher manipulates the independent variables of their choice and examines the effect of the dependent variable, while at the same time trying to control other confounding factors. Going through all this, okay, the researcher can also measure intervening variables, the knowledge of the participants, and experiments have the advantage of testing the effect of conditions that may not exist in practice, okay, or a situation where something's happened in the past, but we don't have enough evidence to be able to come up with some solid analysis. So we try to recreate that event from the past, okay? Experiments can also be used to disentangle interrelated factors that coexist in the natural environment, okay? And try to work out what factors are the most crucial here, okay? Now, that's a nice summary. If you were studying and you wanted to understand the differences here between, okay, if you wanted to understand the differences here between what is capital markets research and what is behavioural research, okay, just so we can understand where the differences are, okay. Now, I won't spend too much time on that slide because it kind of summarises what we've talked about, okay. Now, there's a few things that we need to talk about, and one of these was used back in the 1970s and 80s, and it was called the Brunswick lens model. And it was a common way to conceptualize or understand decision-making processes, okay? So perspectives about the environment were observed through a lens of imperfect cues, okay? And so what they were trying to do, they were trying to use statistics to understand, okay, what cues led to success or what cues led to good decision making, okay? So they're trying to understand when making a decision, what was important. Now, the right-hand side of the model show, the right-hand side models how the individuals uses cues to make an ultimate decision. So a good example of a cue would be, if I see that there's rain on my window, that gives me a cue or an idea that I should take an umbrella, okay? The left-hand side models the relationship between the actual phenomenon and the particular cues. Is there a relationship? Okay, so what we're looking at, we're trying to understand what cues help us in reaching a judgment, okay? So you might have someone who, we're trying to work out if someone's going to be successful. And this could be some of the cues, what their GMAT score was, which is a US entry score, or their grade point average, or the quality of the university they went to. Now, the structure of the lens model can be applied to almost any decision-making scheme, i.e. lending, risk assessment, bankruptcy assessment, and it explicitly considers the inputs and the ultimate decisions that are made, okay? Now, there's a bit of a list here, okay? Types of issues to be considered, okay? Now I'm going to go through these in a little bit more detail in the coming slides. So the first of these, okay, how and whether particular cues are used in decision making is particularly relevant to the accounting profession. And the reason for that is if information items in financial statements are not used, then maybe they're deemed to be immaterial. So what does it mean to be immaterial? Something is immaterial if its omission or misstatement would not impact on decision making. So something is material if its omission or misstatement impacts on decision making. Okay, so the question becomes, if information isn't considered to be relevant, why do we bother even preparing it? Why do we waste our money creating accounting standards? And why do we waste our money preparing financial statements based on this information that no one really has any importance for anyhow? Okay. Another important thing is that when we present information, is it more important to have it presented in the face of the financial statements, or could we put it in a footnote? Is one more important than the other when people are making decisions? Okay, because if we're finding that people put more regard to what's on the face of the statements and they're ignoring the footnotes, maybe that could give us an indication that we actually need more information in the financial statements and maybe simpler, easier to read footnotes. Because as you know from when you've looked at your assignments and those sort of things, some of the companies have footnotes that go for 30, 40, 50 pages and can be very complex. Maybe there's no benefit in doing that. Now, so what's our evidence? So it says here, making predictions of financial returns, analysts are found to acquire earnings and sales information more than other types. So they're interested in things like profits. They're interested in things like sales. Maybe they're not so interested in cash flows, which is what we've often thought they would be interested in. Maybe the balance sheet doesn't have as much importance as perhaps we thought it would. Okay. Last week or a couple of weeks ago, we talked about historical cost versus fair value. Now, this was a really big issue during the 1970s. And the reason it was such a big issue in the 1970s is we had large or really high levels of inflation. And a lot of people felt that historical cost wasn't really that useful. Okay. So they did a number of studies and they questioned the provision of current cost information similar to fair value. But what they actually found is that despite all these ideas that we should have new accounting methods, despite all these ideas that inflation was rampant, so historical cost wasn't useful, what we ended up finding, okay, is that basically people still relied on historical cost information. Now, the next thing you would ask is, why is that? And you would have probably found in hindsight that the information that was presented using current costs was really confusing. So people would have gone back and just relied on their historical costs, okay? Now, we also found that different presentation formats are found to influence users' decisions, okay? Bar charts, line graphs, pie charts, tables. Sometimes they found that, you know what, people understand some better than others, okay? Maybe that means that, you know, we maybe have to specify in financial reports how information is displayed. Maybe we need more use of bar charts, etc. Now, Moriarty, okay, this is a really interesting study, found students and accountants using churn-off faces were able to outperform those using ratios in predicting bankruptcy and models of bankruptcy. So churn-off faces are basically these faces, and they change. You change the face depending on what you're trying to portray. And you can look it up, and they've used it in many different ways. So if the number was good, maybe they had a happy face or a positive face or a smiling face. And if the number or the ratio was bad, instead of having the ratio there, they might have had an expressionless face. But what they found out is that people were actually able to interpret the information better with one of these churn-off faces than if they were given actual financial data. Probably says a lot about the fact that if you're given too much information, people will often only focus on a few pieces of relevant information, and maybe there was just too much when this study was done. Now, studies examining decision-making by loan officers based on whether information is incorporated within the financial statements or in the footnotes found presentation made no difference. Now, that's probably because loan officers have some accounting knowledge. I wonder if you did that same study with people without accounting knowledge or only a very basic accounting knowledge, they would have reviewed it the same way. Provision of segment information reduces subjects' reliance on past share prices. So segment information means that we break up the information in the financial statements, maybe based on geography or product or something like that. And it basically found that users find that information more informative than looking at past share prices, etc. Now, a cue is something that gives us an indication. So like I said, if I see rain on the window, that's a cue that it's raining outside. Or if I hear the wind is rattling my windows at home, if I hear that, it's probably a pretty good indication that maybe it's cold outside and that maybe I need to rug up. So studies have examined how the various cues are weighted, and judgments have been found to be consistent over time. Now, the decision makers have been found to employ what we call a simplifying heuristic. And in simple, it's a rule of thumb. So my rule of thumb is that if I see rain on the window, I take an umbrella. It's a rule of thumb. Now, it's going to be right most of the time. It may not be right all of the time. So these rules can be employed. They take a lot less time, but they generate acceptable predictions. Okay. It's useful to know about the use of heuristics. So if we have successful decision makers, so a successful investment banker, what are his or her cues? Maybe we can replicate that and make money ourselves that way. So when we talk about a heuristic, rather than fully considering all of the potential relevant factors, a simplifying rule may be employed which takes a lot less time, but might generate a fairly acceptable prediction. Okay, so I look at the window, it's raining. Okay, I take an umbrella, I get it right most of the time. Alternatively, I could look at the weather on the television. I could look up the internet, see what the weather's like for my area, what it's going to do for the rest of the day, make a judgment that day, and I'll probably arrive at the same one as I would have arrived just knowing it was raining. So, with that in mind, they talk about three simplifying heuristics: representativeness, anchoring, and availability. So let's have a bit of a look at that, shall we? Okay. Now, these heuristics have been researched within the psychology literature. Okay. Basically, they reduce the complex task of assessing probabilities to simpler judgments. And so while these heuristics are quite useful and lead to efficient decision making, they can sometimes lead to systematic errors because you're always making the same errors. Okay. Why? Because you may be omitting certain factors that are really important in the judgment process. Okay. Decision makers often assess the likelihood of items belonging to a category by considering how similar the item is to a typical member of that category. Okay. An implication is that the subjects typically ignore the base rate of the population in question. Okay. So an implication is that subjects typically ignore the base rate. Decision makers often assess the likelihood. So what often judgments are made when coming to the conclusion that something belongs to a particular category. So we put it in that category. Okay. Individuals make an initial judgment or estimate. Okay. So just going back. So that was representativeness. It belongs to a certain class, and so it's represented by that class. Sometimes it can lead to problems. Like it said, you may overstate the number of cases. Okay. Sometimes the source is unreliable. Anchoring and adjustment is really interesting. Individuals make an initial judgment or estimate, and then they only adjust their view if they've been given additional information. So if there's no information, people won't change their mind, is what the belief is. Availability, okay. This talks about recollections, when people remember something that they might have seen or heard before, okay. So it relates to whether recollections of related or similar occurrences or events come easily to mind, okay. The actual base rates, how common it is, are ignored, okay. The problem is if you've got something that's sensational, widely reported, okay, the probabilities associated with that tend to be overstated. We give it a greater importance than perhaps we should, okay. Now, it's useful to know of heuristics in use. If the heuristic results in inappropriate decisions being made, the tendency can be highlighted and action can be taken, okay. At the same time, the use of heuristics or cues by experts could be more efficient than having to go through a costly data gathering and processing. Sometimes you may pay an expert to make a judgment. They're going to use their heuristics than having to do that yourself, but having to collect more information and spending a lot more time gathering, analyzing, that type of thing. So in looking at the actual output of the decision-making process or judgment, some researchers have considered how accurate the predictions are relative to the actual environmental outcomes. Okay, so Libby investigate the accuracy with which loan officers predicted business failure. Okay, and research has considered how accurate the predictions were relative to what actually happened. Okay, bankers and accounting students were found to correctly predict bankruptcies according to Zimmer. Okay, and they also found that decision makers working in a team can outperform individual decision makers. Okay. Protocol analysis. This form of behavioural research requires subjects to verbalize their thought processes when making decisions, and they use that in audit research. Okay, so we trace the actual decision-making process of users of financial information, and it's suited to studying ill-structured tasks. Protocol analysis allows the research to identify cues, the sequence in which the cues are utilized, and determine their relative importance by the frequency of their use. Okay. Understanding how judgments are made is important to improving these judgments. So understanding the judgment process, okay? And also you might be able to use that to see how people search for information, okay? The process of having to verbalize can maybe impact on your decision process. A considerable portion of the information utilized may not be verbalized. They might be summarizing when they're talking, okay? Subjects may verbalize, but that may only be working in parallel with the actual thought processes. And sometimes when they're verbalized, you've got to code that information so that you can analyze it, and sometimes it could be coded incorrectly. Now, we talked about culture in chapter 4, and some cultures are considered to be more secretive than others. Some cultures seek greater uncertainty avoidance. So differences at a national level were then related back to the international differences in accounting practices that existed prior to IFRS. So culture has been suggested as a factor in influencing how organizations are structured, legal systems, even things like the risk-taking, the size of the organization. Now, it's reasonable to argue that an individual's use of cues will be dependent on their cultural background. People from one country may see some particular piece of information as far more important than people from another country. Studies that investigate decision-making process in particular countries will perhaps not be generalizable to other countries, particularly if there's particularly different cultures. Determining the validity of particular decision-making model across different cultures would be an important area for future accounting research, okay? At this point in time, there is very little behavioral accounting research which explains how the use of cues is impacted by cultures. I know from my own experience in the workplace, different cultures will often approach problems in very, very different ways. In some cultures, they see things as super important at a particular issue. And then in other cultures, they might not see they have placed the same importance on that same cue. So what are some of the research, the limitations of behavioral research? Research examining similar issues has generated conflicting results, and it's been difficult to understand what has caused those inconsistencies. Settings of studies are often different to real-world settings. It's very difficult to replicate cues available in the workplace. Students are often used in place of professionals because it's hard to get people to get involved in a project like that, but students may, or they might receive some sort of small payment which would entice them. And in a lot of this research, there's a small number of subjects used, okay? Now I'm going to stop the share there. Now that's a pretty interesting topic, and it goes through a lot of the way decisions are made, okay? There's a lot of detail there, but just remember, we're understanding when we're looking at behavioral finance, we're trying to work out how decisions are made and how we can use that information to improve the decision-making process and also improve the decisions that are made, okay? So I hope you've enjoyed that. Don't forget to keep up with your various tutorials and those sort of things, and keep on working really, really hard. And I will speak to you next time we have a video together. Thanks very much and have a great day. Bye.